All right, hi everybody. Welcome. Appreciate you coming. Last week of classes of the semester. I'm Matt Burgess. I'm an assistant professor of economics here at the University of Wyoming. This is going to be a live taping of Grounded Not Divided, which is my podcast. And it's a show about leaders who are getting important things done in the real world. The philosophy is, instead of inviting talking heads, professional talking heads to say the most inflammatory things they can say about whatever the issues of the day are, let's get real people who work on these things in the real world and let the nuance bubble up from their experience. That's the philosophy of the podcast. And I'm very excited to be joined today by Skip York, who is a very distinguished alumnus of the economics department here at University of Wyoming. He's a non-resident fellow in energy and global oil at Rice University's Baker Institute for Public Policy, and he is chief energy strategist at Turner and Mason and Company, which is an energy consulting and advisory firm. Dr. York was formerly head of commodity strategy for Petroleum at BHP, and he has experience working with ExxonMobil, McKinsey Company, Charles River Associates, and Wood Mackenzie. Those are all very prestigious, famous outlets in energy consulting or both. He received his undergraduate degree in economics from the University of Wyoming, and he holds a Ph.D. in economics from the University of Virginia. Dr. York, or would you rather me call you Skip?
No, call me Skip.
Welcome to Grounded Not Divided.
Thanks for having me on. I'm pretty excited about kind of doing this forum.
So what an interesting time to be talking about energy and energy strategy. For those of us in the room like me who are novices, what is strategy? What do you do on a day-to-day basis as an energy strategist?
So I have a bit of a unique definition of strategy. I think strategy is what you're doing. What you're doing with strategy is you're trying to make the set of choices that you can make to bridge yourself from where you are today to where you aspire to be in the future. And quite often, the answer to most strategic questions should in fact be no. No, we're not doing that. Because there's a lot of great ideas. You have more, every organization I've ever seen has more ideas than they have time or resources. And so what your strategy does, your strategy helps you really kind of take that funnel of great ideas and funnel them down to the ones that really drive this organization, whether it's a corporation, an institution, a university, a nonprofit. It's the series of choices we're going to make to drive the organization into its future. We're going to be making our future by making these choices today.
Now, when you're talking about oil and energy, you're talking about basically the base of the economy, right? And you're talking about, as we're learning with the Strait of Hormuz, a system that has a lot of inertia in it. There's a lot of industries that have very high dependency on those costs. So when you're doing strategy in this sector, what sorts of time horizons are you thinking?
So I think you're thinking, and I think shale has really kind of changed this. I think if you think of the oil and gas industry pre-2010, before the shale revolution started, you were really kind of looking at a timeline of, call it 5 to 7 years. Shale, because it can happen so quickly. You can go from drilling to first oil or to first dollar within, if the whole supply chain's lined up, you can do that easily within 8 to 12 weeks. So shale gets measured in weeks, not in years. Or shale development gets measured in weeks, not in years. And I now think the time frames we're thinking about, and this also goes back to my time at BHP, and for people who don't know, BHP is the world's largest miner, so mining company. To put it in perspective, they are to iron ore what Saudi Aramco is to oil. So they're the largest iron ore miner in the world, and they actually have the ability to move the price because they have such a they're 30% of global iron ore production. So at BHP, when you're looking at a mine, you're looking at probably 10 to 20 years to develop it, and then a mine that's going to be online for 50 to 70 years. So I now think when you think about time frames, it really is important to figure out what are we doing over the next, call it 0 to 5 years, what are we doing in the next 5 to 15 years, maybe 20 years? And then what do we aspire to be doing 20 years out? And trying to think about, and this is where if you've got a well-founded strategy, a well-thought-out strategy is going to be handing off those time frames to each other, rather than 10 years out, you get out and say, well, this isn't where we want it. Gee, we did all this short-term stuff, and now we're not where we wanted to be. A really well-thought-out strategy is going to be handing off the 5-year period, hands it off to the midterm hands it off to the long-term. And that's how you get that, those really cohesive decisions. So a lot of what we have to be thinking about well, let me back up. Now, here's the challenge to that, is that quite often, if you're thinking in terms of corporations are measured on a quarter-by-quarter basis. And it's really hard to get equity analysts to think beyond 2 to 3 quarters into the future. So that's the challenge for the leadership of energy companies, is they're making decisions. The decisions they're making today are for 2030, but they've got to also be able to communicate to stakeholders who only care about the next 90 days. And that's a real challenge for them to do. But let me give you an example. Is when Maduro was arrested in early January. The president of Venezuela was arrested and flown to New York. I did a lot of media work, and a lot of reporters were asking, why does anybody care about oil in Venezuela when it costs $70 or $75 or $80 to drill the well, but oil prices are only $60 a barrel? So why does anybody care about Venezuela? Why do oil companies care about Venezuela? Who would possibly care? And I said, well, every oil company that has a portfolio that's going to last more than 10 years cares about Venezuela. Because they understand right now, I'm not going to be producing oil in Venezuela today unless I'm Chevron. I'm looking at Venezuela for, does Venezuela help my 2035 portfolio? And those are the decisions. And I said, and the decisions they're making today are about their 2035 portfolio, because their portfolio from now to 2030 is pretty much set by what they have in hand. And that's where I think these timelines are becoming more complex, which actually makes them more interesting.
Yeah. Okay, so a little over 2 months ago, the US and Israel attacked the Iranian regime, and the Strait of Hormuz was closed for all intents and purposes to shipping traffic. Let's talk about the day before that happened. What is going through that strait, and where is it going? And what fraction of different, oil, fertilizer, other really important commodities are we talking about?
So let me go back with something. Let's just talk a little bit physically about the Straits of Hormuz and why is it so important. At its narrowest point, so you have the Persian Gulf to the west, and to the east you have the Arabian Sea. And the Strait of Hormuz is where those two bodies are kind of coming together, and it's a very narrow maritime choke point. It is so narrow that at its narrowest point, it's about 20 kilometers from the southern coast of the United Arab Emirates to Iran on the northern coast. But the navigable water within that 20 kilometers is really only 2 kilometers wide. And so what we have in the Straits of Hormuz is we have 2 lanes of traffic. We have an inbound lane that's 1 kilometer wide. There's a 1 kilometer buffer, and then an outbound lane that's 1 kilometer wide. So a little less than, maybe 2/3 of a mile wide. That may sound like a lot of space, but now you think about a VLCC, a very large crude carrier, that's longer than a football field. It takes it probably 10 miles to make about a 30-degree turn because it's so long. And that's what makes it so difficult, is because at that narrowest point, you are making a turn in this, where the Hormuz is the most narrow is also where there's a turn involved. And that's why shipping traffic has to be really well thought out, kind of like an air traffic controller. So what's moving through there? Before the conflict erupted, somewhere between 100 and 120 ships are moving through there, outbound every day. And then you've got sort of similar numbers moving inbound. And those outbound numbers were not just oil tankers, but crude oil tankers, petroleum product oil tankers, LNG tankers, or liquefied natural gas tankers, fertilizer ships, aluminum, steel, Those are largely what's going outbound. What's coming inbound are either empty ships or foodstuffs. So about 90% of what the Persian Gulf countries consume in terms of foodstuffs is coming in by water through the Strait of Hormuz. What's going outbound for oil, whether it's combined oil and products together, we're a 100 million barrel a day market, roughly 20 million barrels a day of crude end product is moving through the Straits. So 20% of the global oil supply moves through the Straits. 20% of the global LNG supply moves through the Straits. 30% of the world's fertilizer moves through the Straits. Now, the steel and the aluminum isn't, they're important, but they're not that big in terms of what the world needs. So that's what was flowing through there beforehand. And then the conflict begins. And we basically, it's basically strangled down to maybe we're somewhere in the neighborhood of, instead of 120 ships a day, we're down to 10 to 15 ships a day. We're tracking about 6 to 8 ships moving through there. But there's increasing anecdotal evidence that we got maybe 2 or 3 times as many ships that are moving through there. And they're moving through there because they've turned their GPS off. They're spoofing their location, so they actually spoof a location that makes it look like they're out in the Arabian Sea, but they're actually transiting through the Hormuz. But you're still at the case, even if it's 15 ships, you're still at less than 10%, or a little more, no more than 10% of what was flowing through there before the conflict started.
Quick follow-up. The ones that are going through, say 10% at best, are those something like a random sample of what was going through before, or are they specifically certain countries, specifically certain products? What do we know about those ships?
So predominantly of those, so you think of those 15 ships, they're predominantly petroleum related. They're crude and product vessels. We didn't see a lot of fertilizer ship moving, and then there was a period 2 weeks ago. We had a 2-day period where all of a sudden 40 fertilizer ships moved through the Straits, and then nothing before, and then nothing since. But most of that traffic is oil related. Most of it is originating in Iran, and that's now being choked off because the U.S. has now established that blockade out in the Arabian Sea. So what's still now transiting through there is now we don't have as many Iranian vessels moving through there. Now we have a mix of other vessels, but they're still largely petroleum related vessels. They're crude vessels, and when they're moving products, they tend to be sort of what are called LPG tankers, or liquid petroleum gas, so we call it propane in the US. So that's largely propane that's moving to India to keep and that is a critical fuel for the Indian economy, especially for residential cooking.
So follow up there. You said it's 20% of the global oil supply. It's 30% of the fertilizer supply. But that's not evenly distributed across all countries. So isn't it more than 20% significantly of, say, some countries in Asia? Who are the regions that are most affected for oil and for fertilizer?
So on the oil side, about 80% of the oil flow is heading to Asia. Probably about 85% of the LNG was going to Asia. For the fertilizer, it's kind of split between Asia and Africa. So if we're sitting in the Western Hemisphere, we're not being impacted by the flows because a lot of oil doesn't flow. Now we were at a point back in the 1980s where 6 or 7 million barrels a day of oil was coming out of the Middle East and coming to the U.S. That's down to about 500,000 barrels a day now, and it's really very much logistically driven into the U.S. West Coast and the U.S. East Coast. But we aren't dependent on the Middle East the Western Hemisphere doesn't depend on the Middle East for fertilizer. That's largely coming out of the U.S. and Canada. So this is why this is really turning into an Asian, from a consumer standpoint, this is really turning into an Asian story, because they're paying the price in terms of oil. They're paying they're losing supply of oil, they're losing supply of natural gas, and they're losing supply of fertilizer. The fertilizer one is the one that's kind of timing critical, because we've missed the planting season now for a lot of these locations, and so we're going to see a drop in yields because they had to plant without fertilizer, and if you get fertilizer later, that's not, it's not a bad thing, but it's not going to be as good as having a fertilizer season as opposed to we're doing it at the very end. So that's going to become a concern, I think, when we head into the fall and we get into the harvest and we've got those declining yields in heavily populated parts of the world.
So let me ask a related question about lags.
Right.
So if you watched oil futures markets, which I did daily, have been doing daily for the last 2 months after basically never doing it. The market bounces up and down on whatever the president is posting on social media some days, right? There's stories about how because of the time it takes the ships to get from the Strait of Hormuz to wherever they're going in Asia, there wasn't actually an acute shortage right away because the previous deliveries had already gone out. So I guess my question is, when and where have we started to now hit acute shortages? It sounds like you think we're there already for fertilizer. Are we getting there for oil and gas? And how much do we see at the pump is caused by that as opposed to what finance people call Mr. Market?
Mr. Market. So I think you're right. On fertilizer, we're seeing the pinch on fertilizer already because we've missed the window, broadly speaking. On the oil side, you're right, is we didn't really feel it in March because all of the oil that was going to be delivered in the month of March had already transited through the Straits of Hormuz, or virtually all of it, had already transited through the Straits of Hormuz and was on the open seas when the conflict started. So what we saw in March was a reduction in refining utilization, but that was a reduction in refining utilization not because they didn't have the oil, but because they were thinking, what if I don't have, what if this isn't resolved in a month? What am I going to do about April and May? And so I'm going to reduce my run rates now in an effort to conserve volume. I'm going to take that volume that's coming in and essentially put it into storage. We saw a further reduction in refining runs in April because now we don't have ships coming through, and now the only thing they can run on is the oil that they have in storage, oil that gets released from their country's strategic reserves, or oil that they go out and get on the free market. And that's been sort of something that's kind of gotten lost in all the numbers. So let me give you some numbers. If you think about Asia, just crude oil heading to Asian refineries, that's 12 million barrels a day coming through the Straits of Hormuz, say in February. Of that 12 million barrels per day, 8 million barrels of it has been made up. And it's a combination of 7 million barrels a day has been made up by diverting flows through two pipelines, one that runs across Saudi Arabia and one that runs across the United Arab Emirates, the UAE Peninsula, and there's actually a loading facility outside the Strait of Hormuz. And then the Saudis are loading in the Red Sea instead of loading inside the Persian Gulf. And most of that oil is going to Asia. Some of it's going to Europe. Some of the Red Sea oil is going to Europe, but most of that's going to Asia. And that was about 7 million barrels per day. Then there's a pipeline that runs from Iraq to Turkey, which had been out of service for diplomatic reasons and commercial reasons, has now come back into service. It's running at well below capacity because they still have a lot of commercial and diplomatic issues to resolve, but at least there's some oil flowing through that pipeline now. But then what's missing is there's 1 million barrels a day in April, and we'll see it again in May, but in April, 1 million barrels a day of US crude oil was flowing to Asia in the month of April. 1 million barrels a day more than what was flowing in February. So virtually all of the increase in US crude oil exports since the conflict started have been going to Asia. So that means Asia now lost 12 million, but figured out a way to make up 8 million of it. So I'll put air quotes on this, right? They're only 4 million barrels a day short. Now that's still 4 million barrels per day. And to put that in perspective, that's roughly the production of a couple of counties in Texas, because Texas produces 6 million barrels a day. So that's basically West Texas. It's a huge number to try to solve. But it does explain why utilization rates are rising in May in Asia, and why we've been saying we're not seeing the big storage draws that we thought we would see. Well, we're seeing storage draws that are more akin to 4 million barrels a day than to 12 million barrels a day. Now, here's the problem with that. Once you pulled a barrel of oil out of storage, you've used it. There's not another barrel behind it until you start to refill the storage again. So all that repositioning of that crude oil has done is it's going to make the storage last longer, but there still is a period of time. If this goes on long enough, you will in fact drain the storage. But you are going to drain it at 1/3 of the rate that we feared we were going to be draining at in March. So that's a little bit of a silver line in the cloud, is that because of this repositioning, storage is going to last longer, but that doesn't mean that we should tolerate the conflict going on. That doesn't mean the pressure is off to end the conflict. This strait needs to get reopened. Period. Full stop. Because it's not just an oil story. That fertilizer and the metals aren't going to move, and the petrochemicals aren't going to move until the Hormuz returns back to sort of normal operations. And that's going to take from the day, not that the conflict ends, from the day that the conflict ends, there's going to be a lag until people develop a confidence that they can sail through the straits. Who knows how long that period, but that's going to be probably measured in weeks. And then the shipping companies that I've talked to have said it's going to take 3 months to rebuild the supply chain. So even if the conflict were to have ended May 1st, we're still not, the global oil system isn't back in place until September. And so, every day that this goes on, or every week that this goes on, that 3-month lag is still sitting out there. And that's going to just, and that's just going to be how we have to work through it. Now, I will say, my bet is if I took the over or under on 3 months, I'd take the under. Because there's going to be there's this huge commercial incentive to try to figure out things faster than slower. And the industry has a history of doing this. If you think back, when the Iran-Iraq war, when the Iraq invasion of Kuwait ended in 1991, as the Iraq army was retreating, they lit all the oil wells in Kuwait on fire. And the initial estimate was it's going to take 3 to 4 years to put all those fires out. Took more like 7 or 8 months. Why? Because 2 things. They were highly motivated to put the fires out so they could get the wells back into production. And 2, as they started putting the wells out, they started to get smarter about how to put the wells out. And so there was actually this learning curve, and they just got better at it as they were doing it. Second example, a little bit more contemporary. When Russia invaded Ukraine in early 2022, oil prices spiked. But by the end of the year, oil prices had effectively returned to where they were before the war started. Now that war is still going on, but oil prices had returned because it took a couple of months, but it only took months for the global oil logistics system to figure out how to rearrange itself so that you could still supply the world, despite the fact that you'd cut off a fairly big chunk, but not all of Russian supply.
So you told us somewhat of a glasses half full story, and yet Fatih Birol, who's the head of the International Energy Agency, said a week or 2 ago that this was the worst oil crisis in world history. Why did he say that, and do you agree?
So he said it because if you just look at volumetrically what came offline, which is 20 million barrels a day between the crude production and the refineries that have closed or reduced runs that sit inside the Persian Gulf, we've lost 20 million barrels a day of supply. So just looking at the number, that's the biggest supply reduction we've ever seen in the world on the supply side. Now, people will say, well, it's of the same order of magnitude as COVID, but COVID was demand-driven, not supply-driven. So that when demand returned, the market quickly returned back to previous levels. If you go back to supply disruptions, the next biggest supply disruption was the Iran-Iraq war in the late 70s and early 80s, where between the 2 countries, they lost 8 million barrels a day of production. 6 million of that was in Iran, and I'll fast forward to the spoiler alert, 4 million of it never came back. Now, a lot of that was probably is regime driven as opposed to geology driven. But I would say that was a bigger crisis for the world than the one we're going through now for two simple reasons. One, 8 million barrels a day was a much larger percentage of global oil supply in 1979. But more importantly, two, the world did not have the relief valve of U.S. shale. So if you think about back in the late 70s or 80s, early 80s, the U.S. was probably producing somewhere around 8 million barrels a day, maybe less, as opposed to 13 million barrels a day now. So that's part of the reason why we've got more flexibility in the system now than we did in the 1970s, and I think that's why, that Iran-Iraq war actually was the precursor to the 1980-82 recession. We have people talking about slower economic growth and that the probability of a recession is increasing because energy costs are rising. But we don't have anybody out there saying that there's another recession. There's a recession looming. And to put it in perspective, the 1981-82 recession was the largest recession since the Great Depression up until the financial crisis. So it was big. That was a big economic shock to the world. I don't think we're going to see that big of an economic shock on this one. Now, it all goes to if this goes on long enough, then eventually this becomes a cumulative effect, and it's a downward spiral. But I don't think we're going to get there.
So let me ask a follow-up question about that. How long is long enough? Are we talking 3 months, 6 months, a year or two? Let's say this goes, which wouldn't be atypical for a war, 4 or 5 years.
Yes.
What does that look like in terms of the economy and in terms of energy prices?
So I think we've already baked in that global GDP is probably going to be about 0.5 point slower than it would have been absent the war. So the IMF, before the crisis, the IMF forecast for global GDP growth was 3.2%. They've now lowered it down to 2.7% based on the conflict. But they're very clear that that's based on a conflict that ends in June or July. They say if it extends throughout the end of the year, then we drop from 2.7% down to, I think it's 2.2%. The mistake here is don't think that every 6 months we just take 0.5 point away, right? Because I think what happens then is if it extends beyond calendar year 2026 and we get into 2027, I think the decline in economic activity starts to decline at an increasing rate.
Why is that?
I think it goes back to that because we will have been draining storage now for, say, by the time we get to March of 2027, we'll have been draining storage for 12 months. And you're going to start getting to the point of where you now start to think about two things. First of all, we started the conflicts at about 6 billion barrels in storage globally. And it looks like we've pulled out 500 million so far. But of the 6 billion barrels, you can't use all 6 billion. So you can use like maybe 5.5 because there's in the bottom of every tank is what's called a heel. And the heel is part of the volume that's in storage, but it's not usable. It's not usable, and it's not usable for operational reasons. It's also not usable because it tends to be where all the sediments and the crud tends to settle. And so you leave that kind of oil in place just so you've got more operational capacity. But if you pulled out 500 million barrels in the first 2 months, you're going to probably accelerate the rate at which you're pulling it out. And now you were saying I've got 5.5 billion barrels to play with, if I'm only doing 500 million barrels, that's 11 months. So I'm going to run out of storage well before a year because I'm probably going to accelerate the longer we go into it. And I think that's where the economic risk comes from, because the only way you solve the problem now is you now have to actually destroy demand. And when you destroy oil demand, you destroy economic activity.
Right, that makes sense. Now, you mentioned already that the Western Hemisphere, and to some extent the world, has been somewhat buffered this time by the increased production in the United States. Wyoming as you know, is a big mineral producing part of the United States. So what do you think the economic impacts of this are in the United States and in Wyoming as we go longer? How high do you think that the price of the pump's going to go? Is this going to be a positive or negative on the net for the economy of states like Wyoming? What's your take?
Oh, good question for Wyoming. I could tell you for Texas, for Texas and Alaska, it's a net benefit. Not that either one of those states wants the benefit,
Sure.
but that's the reality. For Wyoming, you've got two things. You've got oil production that's going to price at a higher price, but to really take advantage of it, you've got to put more rigs in the field, and that's something we haven't seen in the rig count. Since the crisis started, we quickly added 10 rigs in the U.S., but we gave those 10 rigs back by mid-April. We've kind of moved sideways ever since then. And that's because the issue isn't drilling, the issue is completions. So it doesn't do you a lot of good to drill more wells in Wyoming if you can't get a completion crew to frack, complete, and connect the well to the market. And I think that's what we're seeing across the entire country. So Wyoming has, the challenge for Wyoming is the existing production is going to realize a higher price. We don't see a lot of signs of more drilling activity, which would then grow the volume on against that price. And on the other side, you've got a state that is largely rural, so large transportation distances. And that means higher gasoline prices disproportionately impact people in Wyoming relative to people in Houston, Texas, because people in Houston, Texas don't drive as many miles per year as people in Wyoming do. So on a net, I think my intuition would be it probably all washes out, which is kind of like, so you're not as well off as Texas, but at least you're not California, which is
right.
really really starting to feel the pinch, both in terms of higher prices, but also now in terms of specifically for them, it's not gasoline, it's jet fuel, where we're starting to see significant declines in jet fuel imports into California. California imports 25 to 30% of its gasoline. That's largely still intact because it imports gasoline from Asia, which is more of a diesel market, so gasoline's a byproduct. But jet fuel is a global product, and we've lost 20% of their supply of jet fuel supply globally. We lost 10% when the straits closed because 10% of the world's jet fuel supply were exports coming out of the Middle East. And the other we've lost, because of the reduction in Asian refining runs, we've lost another 10% of jet fuel supply. So we're really starting to see that pinch in Europe, but within the US, we're really seeing it in California. And California is a precursor for what the rest of the country looks like if this conflict becomes prolonged.
So let me ask a follow-up question about that. What is it about California that makes them the first line of symptoms for this problem?
So California is often referred to as an energy island, and it's called an energy island really for two reasons. One, physically, the state is not connected to, on an oil side, the state is not connected to the rest of the country. So it has product pipelines that flow out into Nevada and Arizona, but there are no crude oil pipelines coming into the state. When the shale revolution started and California refiners started putting in rail facilities so they could rail crude oil in, like they've done on the East Coast, they ran into a lot of environmental and regulatory opposition, and so those rail terminals were never built. So they can't rail crude oil in from the rest of the U.S. The only thing they're connected to is Alaska via ships coming down. So that's one reason why there's a physical dimension to the island. And the other one is regulatory. The product specifications in California are much stricter than anywhere else in the world, and it makes it much harder to make products that meet specifications. And California also does something a bit unique, that if you wanted to import product into California, not only do you have to meet the specification, but you have to be certified by the California Air Resources Board. Your facility has to be certified before you can bring it in. So anywhere else in the world, if you're exporting diesel fuel into Europe, You just have to be able to meet the spec. You don't have to have EU inspectors come in and validate and attest. But for California, you do. You have to be registered with CARB, and you have to go through this registration process, which is a bit onerous. And a lot of refiners resist doing it because the volumes that they're talking about, because you have to put it in segregated tanks, because you've got to keep it, once it's on spec, it's got to stay on spec. It's really hard for them to do the logistics. So it's not that they lack the ability to make California fuels. They lack the logistics to move California fuels, which means they don't go through the certification process. And so that regulatory environment or that specification environment is a further way that they've kind of put themselves on a fuels market island.
So in Wyoming, I know there's heterogeneity across the country, but in Wyoming, we've gone from something like $2 a gallon at the pump to just over $4 a gallon last week. Let's say this goes on another year. Are we getting to 6? Are we getting to 8? Where does it stop?
No, I think, I don't anticipate, let me sort of say, if the conflict were to end today, I would expect gasoline prices, ironically with the possible exception of California, I would expect gasoline prices to continue to rise in the US, even after the conflict ends. And the reason why I say that is, although retail prices have risen, wholesale prices have risen further than retail prices. So there's pent-up price increases that haven't made its way to the street everywhere in the US with the exception of California. So I think there's still this upward pressure on retail prices. But if you kind of look at crude markets and really what's driving the retail price, the biggest driver right now is crude prices. Crude prices have kind of pretty much moved laterally for about the last 4 weeks. So, between $100 and $110 a barrel, kind of up and down for about the last month. If that were to continue, then I would expect sort of, we see that catch up between the wholesale prices and the retail prices, and then prices would kind of stabilize. If this really goes on long enough, and we start going into the storage, and we really start running short of storage, both on crude and on products globally, then we're going to see a lot of upward pressure, and I think it's a hockey stick, because I think we're going to have to run prices up high enough that we actually encourage people to get out of their cars, because I don't see the U.S. kind of doing. One of the things that a lot of the Asian countries did immediately is they immediately went back to kind of like the COVID days of working from home and driving every other day, depending on your license plate number. And there's really no sign that the U.S. is going to adopt those sort of non-market interventions. If we don't adopt the non-market interventions, then the only way you clear the market is through price. But I think that's a tail event. Because it's hard for me to envision that this conflict goes on for an entire year, because I don't think, the Iranian economy is teetering, and there's new concerns with the IRGC, which is sort of the political branch of the Iranian military, is probably the best way to describe it. The IRGC is increasingly worried about another round of mass protests because inflation's up 70%, unemployment's up to 60%. I mean, it was an economy that wasn't in the strongest shape to start with, and it's just gotten worse. The situation in Iran's going to get worse. The economic situation in Iran's going to get worse before it gets better. And I also think on the other side, if you kind of think between the U.S. and Israel is, I just don't think there's an appetite on that side of the conflict for this thing to run into perpetuity. And I think what's really kind of driving it from a U.S. policy perspective is the quagmire that Ukraine has turned into. And I think that is of front of mind for the entire political spectrum in the U.S. is that nobody's interested in seeing a 4-year conflict like Russia and Ukraine is ground Russia-Ukraine is ground to a halt, with no sign of how do they actually get out of it. And I think that's true of that'll be true of not only the U.S. political spectrum, but also the Israeli political spectrum as well. So neither side, I think, has any desire for this thing to kind of, let's just see how far we can bend it before it breaks.
So you talked about how in the case of Russia and Ukraine, global energy markets figured out pretty quickly how to substitute, and even this time, global energy markets have figured out partially how to substitute. So that raises the question, are things ever going to go back to the way they were? And if not, how do you think that they'll change? Let's say the conflict ends next month and 2 to 3 months after that, we're back to normal, so to speak, in terms of what could go through the strait.
So I think you never want to predict oil prices on something that's on record because it'll come back to haunt you. But I think the days of returning back to $60 or $65 oil are way off, if never again. And I think the reason why is that at $60 a barrel, you could actually do the math and say, not only did we eliminated the risk premium of the Middle East risk premium disappeared, it was actually negative. And so myself and some of our—
Why did we do that?
Well, I think it's because we'd become, after 10 years of shale oil solving every problem, solving every mistake that the industry or that the world was making was solved by shale oil and shale gas. I think the world had just become complacent. And then when you did the math and you saw that the risk premium was actually negative, myself and some of my colleagues at the Baker Institute, we were saying, this is not sustainable at some point. And that was before the conflict broke out. Now I think the risk premium is back. And I think the risk premium is gonna stick. And I think it's gonna stick in two ways, because I think not only is the oil price gonna be structurally higher above its operational break-even of $65 a barrel. The operational break-even might be $65, $70 a barrel. You're going to put a risk premium on top of it, call it $5. So we're sitting at 75. Now, the other thing I think that's going to happen, and I've already talked to oil companies that have said, the way we evaluate risk in the Middle East has to change. And in a way that a $75 project in the Middle East cannot look more attractive than than the same project in a $60 world, because that $15 difference is because of the risk that you might actually not be able to flow the volume through the Straits of Hormuz. So something's going to happen in the project economics that's going to make the Middle East less attractive, which means the rest of the world becomes more attractive, becomes relatively more attractive. So I think we're going to see, for oil companies, I think we're going to see this portfolio rotation with, not that they'll leave the Middle East, but they're going to reduce exposure in the Middle East and increase exposure in other places. So in a very real way, this situation in Iran couldn't have happened at a better time for Venezuela, because it's going to take Venezuela 7 to 8 years to sort itself out and get projects under development, but it's going to be happening in an environment in which the next best alternative isn't necessarily the Middle East anymore. So Venezuela's not going to be compared to the Middle East anymore. And if Venezuela was compared to the Middle East, it would always lose. So I think that's going to actually help, I think Venezuela will be one of the winners. I hate to use that term in this, but coming out of this, I think Venezuela will attract more capital post-conflict than if the conflict hadn't occurred. The other one that I keep thinking about is, so I got this prediction horribly wrong with Russia-Ukraine. When the Russia-Ukraine war broke out, I said, this is going to be an accelerant to the energy transition, especially in Europe.
You've anticipated my next question. Go ahead.
Yeah. So especially in Europe, but globally, people are going to sit down and say, renewable energy, where I can control the resource, the wind, I control my sun, I control the wind. Nobody can build a big wall and block my wind flow off. Nobody can build a dome over me so they block my sun. Geothermal. So places where I control the resource base not only have an environmental benefit to them, they also have an energy security benefit to them. And I expected there to be this acceleration in the energy transition. Now, it didn't happen. That doesn't mean that we still have investment.
So what did happen instead?
So what happened instead is, largely in Europe, energy transition investments. So investments in renewables continued at the same pace, slowed a little bit, but roughly continued at the same pace. But what we really saw Europe do was pivot towards, it's going to be really hard to get our industrial economy off of Russian natural gas And so what they did is we saw a lot of investment go into an alternate source of natural gas, which was building LNG regas terminals. And that's where the capital flow went. So we didn't see an acceleration in energy transition investments. What we saw was an acceleration of investments in procuring natural gas from a different supply chain, and that supply chain had to move on ships, which means we had to build a different set of terminals because we did, the pipeline, pipelines to the U.S. don't work. So, so I got that wrong. Now I'm asking myself, is this one going to be different? And I think the answer could be possibly maybe. So hopefully I've put enough conditions in there so that I'm right either way.
It's only going to be on the internet, so don't worry about it.
Yeah, it's only going to live for, the following 30 seconds are only going to live forever. So I think there's 4 reasons why this time might be different. I'm going to underline the word might. The first one is this conflict, it's of a larger scale. So we've taken 20 million barrels a day out of the supply, where with Russia was producing 10 million barrels a day, and we really took 2 million barrels a day out. The other 8 million was still flowing, it just flowed to different places. So volumetrically, this conflict is 10 times bigger than Russia-Ukraine. Second thing is Russia-Ukraine was really a European story. This conflict is a European and Asia story. So it's a bigger conflict, it's impacting more parts of the world. It's also impacting the part of the world where oil demand is still growing, which is Asia. So that's the third. And then the fourth one is, it's the second supply disruption in 4 years. And so it might be, that's another catalyst towards, I really have to have an energy strategy that is more robust around hydrocarbon supply disruptions. And that might be sort of really the long-term impact of this might be that when we get out to 2040, the world energy mix might look materially different than it would have had the conflict not occurred.
So I think this is all fascinating from the US policy perspective. So let's imagine a fantasy world where in 2028 we elect a moderate, independent president, okay, who's got and some people in his ear saying, or her ear, saying that we're accelerating the transition because we've had these serial disruptions in supply chains. We need to go all in on renewables, and we need to go all in on R&D for renewables. We need to do our part to advance the energy transition. You got somebody else in the president's ear saying, we have this permanent decrease in trust and confidence in Middle Eastern oil, and we are one of the big alternatives. And so we need to be increasing our investment in drilling and in production here in the United States so that we can meet that global demand. Are those mutually exclusive positions? If not, are they both right? And if they are in conflict, what would be your advice to this hypothetical independent president?
Yeah, so you should never assign a probability to a scenario, but I'll say that the probability of your scenario is roughly the equivalent of me hitting the Powerball. So from that standpoint, I'm all in, because if that actually happens, I've probably won the Powerball. So I'm going to take probably a slightly different tack on this. Is the United States, and this is something I think gets lost when you talk about, I don't know what the term energy dominance means, because I just think it's unconstitutionally vague. But what I would say is, when you hear about the energy dominance discussion, it is often, if you peel the onion, there's a fatal flaw to the logic, which is the United States is not a petrostate. So we don't have, if you're a member of OPEC, and this was a big part of the reason why the UAE left OPEC last week. If you're a member of OPEC, your national economy and your government finances are inextricably tied to the price of oil. So, and that's what makes you a petrostate, is that you are dependent on the oil market for your economic activity and for your financial, and for your government financing. That's not the United States. So my question would be, why do you need to accelerate drilling? Because you're behaving as if This is your only this is the only thing you offer the world is oil and gas. And once oil and gas demand peaks and declines, you've got nothing to offer the world. Well, that's
let me
not the US
clarify.
situation.
Let me clarify, because that was not what I was imagining this
Okay.
person saying. Although I'm
Okay.
sure there are some people who would say that. Just the idea that there's a current, supply and market for oil. I don't think anybody thinks that we may peak and decline by, if you believe the IEA, 2040 or something, but we're not going to go to zero for a long, long time. And so now you've got this disruption to this piece, and we need to make it up with some combination of renewables or oil, and we have the ability to fill that gap. Not as our exclusive benefit to the world, but as an opportunity to profit and benefit as a country. That's sort of what I'm imagining the advice is.
Okay. So in that sense, I would say, the strategic issue for the U.S. is, if you think about, and I hate these either or worlds, right? But just to simplify it, it's either oil and gas. Yeah, or it's both, right? But what I'm going to say is, if it's oil and gas, we have a competitive advantage in that because we have the massive resource base, we have this technology, we have this innovative technology that I keep predicting the end of technological innovation in shale, and I keep getting proved wrong every year. Every year I keep saying, okay, this is it. This is the year when the S-curve finally hits and things plateau from an innovation standpoint, and it hasn't happened. So the resource base combined with that innovation, that's the competitive advantage for the U.S. in oil and gas. It's not either or, it's both. Because that's what makes shale unique to the U.S. so far, with the exception of Argentina, which is largely being done by U.S. companies with U.S. technology. That's why we haven't seen a shale revolution in other parts. There's really three reasons. We have a massive resource base, we have technological innovation, we have firms that are allowed to innovate and build better mousetraps. And the third one is property rights, is that it's clear who owns the resource and then who gets to make decisions about developing that resource. That combination of three exists only in one place, and that's the US. And that's why the shale revolution, we haven't seen it expand in other parts of the world. So that's your competitive advantage. So that's your supply chain. In the renewable space, we don't own that supply chain. That is largely a Chinese-dominated supply chain, whether it's wind or solar. That's a supply chain that's largely dominated by China. So there's fortunately, this mythical president has 3 years. And in the third year, what you whisper is you leverage your competitive advantage in oil and gas because that's what you have. And at the same time, you better be figuring out a way to mitigate the Chinese influence on the renewable supply chain. Whether that's,
How do we do that?
Yeah, and that's the question is, do you have to get into solar panels? Is it around the critical minerals so that, you can have the solar panels, but if you don't have the conductors and we make the conductors, then you've got to have us. I mean, that's a pretty complex supply chain, and you don't have to own all of it. From a strategic point, unfortunately, the Chinese do own that entire supply chain now. It was something that was gifted to them by the Western countries in the 1980s. And we can go into that if somebody wants to, but you don't have to own the entire supply chain to benefit from owning a part of the supply chain. Where you want to be, so this is what I would say to the president, figure out where the bottleneck is in that renewable supply chain, because we know where the bottleneck is on the oil and gas side. It's innovation. And you want to be upstream of the bottleneck. That's where value is captured. Value is always, in any commodity, value is always captured upstream of the bottleneck. So that's the innovation. Now you got to figure out on the renewable side, where's the bottleneck? And then how does the United States position itself upstream of that bottleneck? That's the overarching strategy. So I don't think it's an either or, and it may not necessarily be an all of the above. It's a look at each energy source, where's the bottleneck, and can we develop, or do we have, or can we develop a competitive advantage upstream of that bottleneck? and you go through energy system by energy system. And there might be some energy systems, and I'll just pick one. I'll pick solar panels. You might say, solar panels, there is no way we can get a competitive advantage upstream of the bottleneck, so we're not going to do the solar panel thing. And we're going to actually spend our time on geothermal or on battery storage or windmills, because maybe we can get upstream of the bottleneck.
And when you say we're not going to do it, you mean we're not going to build it here? Because we're already deploying lots and lots of these things.
What I'm saying is I'm saying we, meaning from a government, we are not going to be spending our time designing government policies around an energy supply chain that we can't achieve a competitive advantage in.
So we're just going to let the market figure out how to deploy.
Let the market figure it out. And that doesn't mean we aren't going to install solar panels in the U.S. Right. It's just that we're not going to be, let's not be spending policy time trying to figure out how do we participate in a value chain that we can't capture value from. Let's figure out where the U.S. is uniquely positioned to capture value, and let's be designing our policies around those value chains. And let's let the market, let's just concede the other value chains to the world. That doesn't mean we won't use products from that value chain. It just means that we just aren't going to be spending our policy and our capital. We've got scarce. You think about it. Capital is a scarce resource. Policy formation is a scarce resource. Let's be spending it on where do we think we can have the biggest impact for the country, and let's be designing policies for those areas where we can have an impact. Let's not try and we have to be a dominant player in all of the above. All of the above is going to happen. We have to figure out where in the all are we going to be. Are we going to strategically position ourselves to be, to capture value?
So I'm going to ask you one more question, and then I'm going to save lots of time for audience Q&A. You are a distinguished alumnus of our program. There are several students in the audience. What advice do you have for students on building careers, especially at a time like this that has a lot of uncertainty and turmoil, both technologically, economically, and geopolitically?
So I would say, what's the best way? I got a lot of things to say, so I may not.
Good, yeah.
I've got a lot of noise going on.
Feel free to take as much time as you need.
I got a lot of little angels and devils on my shoulders. So I'm going to say, let me start off with probably the underlying principle of everything I'm about to say is come out of this university with as broad and robust of an education as possible. And the reason why I say it is because of the uncertainty. Your future is more uncertain than my future was. And my own future has been pretty damn uncertain. The broader and the stronger your foundation is, the better you are at adapting to uncertainty. And that's the key to career success. It's the ability to pivot when you need to pivot. When I was in graduate school, I don't remember anybody saying this as an undergraduate. When I was in graduate school is when I started to hear people saying the days of working cradle to grave for one employer are over. And you know what? I wasn't listening to them at all. I probably should have. But if you kind of just the background that you read on me, I've worked for 7 different companies, kind of all in the energy space, but all of them kind of do something different from each other. If I hadn't come out with this robust, broad, deep foundation, I wouldn't have been able to pivot as well if I hadn't done that. And so when I was at McKinsey, they often would say things. McKinsey people are one of 2 types. You can either be an inch wide and a mile deep, or you can be a mile wide and an inch deep. And what they mean by that is you can actually, you can either be the world's most authority on a very narrow subject, or you can know a little bit about everything, but you're not really, a world authority on anything, but you know enough about everything that you can grind. That second foundation is much more robust in an uncertain environment than the first. Because in the first one, if you're an inch wide and a mile deep, and your mile and your depth disappears, you're pretty much screwed. I mean, it's really hard to reset yourself and reinvent your career. But if you've got that broader foundation and you're in one part of that mile width and it dries up or it's not interesting anymore, it's much easier to pivot because you've got a broader understanding across a wider variety of subjects. So that would be my one thing is the broader, so ideally be a mile wide and 2 inches deep. That means giving up a lot of, do they still have boot night here on Thursdays?
I don't know. You're asking the wrong guy.
Yeah, so apparently you'd have to give up a lot of boot nights if you want to be 2 inches deep and a mile wide. But that was really like, be broad and robust with your education. The second thing is be curious. And be curious about doing things that probably the most interesting things I've ever done were the things that I walked in and said, I have no idea what in the world I'm getting myself into. And that's where I've had the most fun. The third thing is, and young employees, when I was at BHP, they really hated hearing this. It's not just at BHP, but I've heard it a lot at BHP. Is you have to own your career, not expect someone to make your career for you. And that's going to be part of the reason why you need to pivot. Because if you let someone else own your career, you pretty much need to expect that you're never going to pivot into the interesting things. Because they're just going to be, if they're owning your career, you're going to be the thumb on that little Dutch boy at the dike. You're going to be the thumb that he sticks into the dike when there's a leak in the dike. And then you're going to stay in there until there's another hole in the dike, and then he's going to pull you out and move you to another. Well, that probably is a recipe for not a very interesting or not a very fulfilling career. So it's those three things. Have a broad, robust education so that it makes it easier for you to pivot. Own your own career, and then be curious and be willing to take risks. And there's stages in your life you can take risks. You can take more risks at the beginning of your career and at the end of the career. It's harder to take risks in the middle of your career, largely for non-career reasons. And I'll just briefly give you mine.
Sure.
I took a lot of career risks before we had kids, and then I was terrified to take a career risk from when our 2 boys were born until they graduated from high school. And then as soon as our youngest got out of high school, all of a sudden I just felt this liberation because they were off on their own. They were both on fantastic pathways. I kind of often wonder why I'm very fortunate that the stork delivered them to the wrong address because I don't know how I got blessed with them. But because once we got through that phase, all of a sudden now I could start taking risks again. And I've taken some risks. And I took a couple of risks, and then all of a sudden it was almost like manifesting the universe, where all of a sudden opportunities that I never dreamed of started coming to me precisely because I kind of broke out of the career path that I was on and said, I'm going to do something different now. And it's really different than anything else I've ever done. And I don't know what the probability of success or failure is, but it's a good thing I don't know what that is because I probably wouldn't take the risk if I knew what the number. Because and all of a sudden, other things started to open up that I'd never thought of happening. Like I wouldn't be at the Baker Institute today if I hadn't made that career pivot that I made shortly after our youngest son graduated from high school. So that's what I mean by be curious. Be willing to take on things that you don't know how it's going to end, and be willing to accept that it may not work. Oh, by the way, I guess can I add a fifth thing, and
yes,
then we'll go to questions. Make a career mistake. At some point in your career, make a mistake. So you can say, oh, so this is what a career mistake feels like. And you'll never make another mistake. You'll say, well, I don't want to make that mistake again. You'll go on to make whole others, but do make a mistake in your career at some point. Do something that you think may not work out, and if it always works out, you haven't taken enough risk. So do something even bolder next time until, it's a bit of the Elon Musk. Bend it until it breaks and then fix it. And I did that, I stumbled into a career mistake. It wasn't like, oh, I think this is going to be a career mistake. I'm all excited about going into it. But I made a career mistake, and I really learned a lot about how humanity works during that mistake, and that really served me later on as a consultant, kind of being able to connect to people that that may not be on board with you've been brought in by the executives to do this. Not everybody in the organization is on board with what the executives have in mind. You have to be able to bridge that gap. Had I not made that career mistake and kind of learned the hard way that you have to deal with people that aren't aligned with what you're trying to do, it certainly made it easier later on to try to get alignment, or at least recognize that you're not aligned, because that was the big thing in my career risk. I didn't realize we were out of alignment.
I'm going to open up to audience Q&A. If we run out of questions, I'm going to ask you what to tell us about your mistake. Audience members can feel free to do the same. I'm going to give the first question to a student, because I promised Bridge UIO that I would. If there's a student who has a question, now's your chance. Going once, oh, there you go.
Yeah, so you talked a little bit about firms reevaluating risk in the Middle East. I was wondering if you could talk more about forecasting risk and forecasting in general for oil and gas firms, especially since they're on these long timelines. Just what is a bad forecast look, and how bad does a forecast have to be before it stops being useful?
Before you answer, because it's a podcast and you don't have a mic, the question was, how do you think about forecasting risk?
Yeah, so I can tell you. The worst forecast is a line. And unfortunately, most oil companies, and I think oil companies are just now figuring it out. I think oil companies have known this for probably 30 years, but they just love that single line forecast, right? And it's just like, we just know this is what the price of oil is going to be. The first thing to always remember about any forecast is, this is the sixth thing about your career: be humble, right? Anytime you forecast something, be humble, because what you know for certainty is that it's wrong. Every forecast is wrong. That's why a lot of times when I was at BHP, what I loved about what we did at BHP is when we did price forecasts, we didn't do a line until the very end. What we did is it was a range, but it actually was a cone, right? Because we were much more confident about the next couple of years than 10, 20, 30 years out. And so there was this cone that we'd go through. Now, that was really for the benefit of the executives who are making the big capital decisions about how far could our price forecast be off and we're still okay. That's what that range of prices told them. But to make practical decisions, the organization needs a single line so that everybody's working off the same, so that all project economics are being done on the same price point. But we would come back and do that with the executives. So we would do a bunch of work that came up with the forecast range, and then it was in the executive session that we actually sat down and problem solved. Well, what's the point forecast we're going to put in there? And we didn't always necessarily put it right in the middle of the range. It was a function of the discussion. What risks were they willing to take with capital influenced what forecast we were going to put to the organization for them to test projects against. So how do I think about how you change? So I don't think you actually forecast risk. I think risk is an input to the forecast. It's not an output. And I think that's where it is, and this is where it gets uncomfortable in the forecasting world, because really thinking about risk in a sort of in a long-term sense or in a forward view, it's really an art, not a science. There's no formula for it, and that's the risk of thinking about forward risk, is that because it's an art, not a science, it by definition has a lot of subjectivity, and now all of a sudden you've got to be really conscious about the biases that you're putting them in. And I think this is the big mistake that people try to do in forecasting, is they try to strip bias out of the forecast. I think the better answer is leave the bias in, but articulate it. Say, we know that we're biased about the following things, and that's likely influencing this line, rather than pretending that somehow you can strip those biases out, because I've never actually seen anybody strip a bias out of their thinking. They just cover it up. And
We're academics, so we've never seen it either.
Yeah.
Question in the front.
John Jenks, I'm with the Wyoming Energy Authority in the statement in the office. Kind of danced around it a little bit, but we were talking about maybe substitutes, commodity substitutes, or I think we were maybe talking about maybe geographic substitutes. I'm a little bit more interested on the commodity side of things. We, as a state, growing interest in possibly getting our coal to the Asian markets, particularly India, Taiwan, Japan even to an extent, but with the political uncertainties and the natural gas constraints that we're seeing to the Asian markets, do you think there is an opportunity there for Wyoming coal to maybe benefit from some of these changes and the demand growth that's happening in Asia?
So the question is, for the online audience, do you think that there's an opportunity for Wyoming to benefit from opportunities to export to Asian markets, particularly in coal?
Yeah, I think the answer is yes, because I think one of the things that will come out of this conflict, probably put Russia, Ukraine plus the Iran conflict together, coming out of this into the 2030s, it's around diversification. I talked a lot about geographic diversification within oil and gas, but I think it's also going to be supply diversification across energy commodities. And so that's going to be, that's where I think there is a huge role for coal. I mean, coal is globally in decline, but that's largely because we're seeing it come out of Europe and North America. But coal is still growing everywhere else in the world. And it's growing everywhere else in the world because it's the affordability issue. It is a very cheap source of BTUs or megawatts relative to other ones. So is there an opportunity for Wyoming to take advantage of that? I think the answer is yes. Because I think, back, I guess call it, back in the 80s and 90s in the U.S., there was actually a premium for Powder River Basin coal because of the characteristics of it for environmental reasons. That would be, those environmental characteristics are the same because the coal still has those qualities, and that would be attractive to coal burning economies. The challenge for Wyoming is going to be the landlockedness, the natural place, the natural logistics is to move the coal west to the West Coast and then load it from ships there, and avoiding the Panama Canal, the cost of the Panama Canal. And that's going to be problematic. But I would say problematic but not impossible. Because I do think, as Matt and I have talked about a couple times, I think there is a change happening in maybe not all of West Coast politics, but specifically in California politics, that's becoming a bit more pragmatic and a bit more realistic about energy in general and their situation in particular. Now it might be moving at from a Wyoming perspective, that change might be happening at a glacier pace, but I will tell you it is that the conversations I have with California lawmakers today are materially different than what they were in 2024. So the possibility of that getting those optimal logistics might be improving, but I think from a Wyoming perspective, you can't depend on it. So you've got to figure out what's my best solution and then what's an acceptable solution. The acceptable solution is going to be going south to the Gulf Coast and then loading from there. And you're either going through the Panama Canal or you're going around the Cape of Good Hope, both of which are much longer voyages than coming off the Pacific West Coast. But I think the opportunity is there because I think we're going to see that diversification of supply. I think that's going to be probably the story of the 2030s, might be diversification, might be the story of energy in the 2030s.
Yep, in the front.
So in the last, call it 8 years, we've seen several, even beyond just commodities and oil, we've seen several global supply chain shocks. You had Trump tariffs 1.0 and trade wars. You had COVID. You had Russia invading Ukraine. You had Trump tariffs 2.0 and trade wars. Now you have the situation with Iran. So I kind of have two questions on this. One is, how much do you think all of these supply shocks have maybe called into question the idea of comparative advantage and global supply chains and just-in-time inventory and this globalization and focus on efficiency in supply chains instead of redundancy and local production sources. You see that trend continuing to switch with more onshoring. And then the other, you kind of touched on it in your last answer, but how much do you think maybe the opposite of pushing us more towards energy transition? Do you think all these supply chain shocks could actually lead us more towards more fossil fuel production from the standpoint of if we have it here, we can produce it, it's more secure, we don't have to rely on some other country. And so in Europe, for example, there's plenty of resources of oil and gas, but they've largely reduced production because of political reasons and energy transition. Do you think that ever makes a comeback? Do you think there's more opportunity for drilling offshore in the UK? And how do you see those things playing out?
I'm going to do my best to paraphrase in 20 seconds or less and tell me how I do. So the two questions were, one, about we've had a bunch of supply chain disruptions, and so is that going to move the global economy away from comparative advantage towards onshoring and resilience focus? And the second thing was revisiting the question that we talked about energy transition. Is global dependence on fossil fuels potentially going to go up because of this disruption?
Yeah, okay, so I don't think dependence on fossil fuels goes up because it's already sort of, I think, somewhere in the neighborhood 78 to 80% of the world's energy is coming from hydrocarbons, whether that's coal, oil, or gas. So it's hard to imagine that share is going to rise. I think what the world's coming to realize is I was always kind of on the over-under of the energy transition or kind of pathway to net zero by 2050. I was always on the underside, just because of the recognition of just how massively large and complex the energy system is, and then trying to change, basically trying to invert that system in a period of only 25 years. Now, 25 years may sound like a long time, but I mean, that is a massive undertaking to try and invert. So I never thought, like a net zero pathway to 2050 was just going to be pragmatic. And I think what's happened over the, really kind of, so maybe starting with the recovery from COVID, because there were going forwards, I think people have just become a lot more realistic about how long it takes to completely turn over the capital stock of something that complex and that pervasive. But to your point, you asked a question specifically about Europe. I'm not optimistic that we're going to see a return of I'll call it traditional fuels. I'll even throw nuclear in the mix. I'm not optimistic that we'll see a return to growth of traditional fuels in Europe, partly because I think they've made policy decisions that they feel that they've kind of locked in and they're not allowed to discuss anymore. I think that's just kind of how politics in Europe are working. The other part of it is Europe is, I don't want to say it's a continent in decline, but population is declining and economic growth is slowing. So the energy equation in Europe is much easier to balance when on a year-on-year basis you need less energy than you did the year before. That's a completely different story in Asia and Africa, where you need more, and every year you need more energy than you did the year before. Now all of a sudden, you can be much more selective about what energy sources you use in a declining energy demand environment. You can't be as selective in a place where you're growing energy demand, and you're growing energy demand because you're trying to grow the economies. You're trying to grow the economies because you're trying to obtain that middle class living standard that Europe already has. I don't think Europe is going to make a pivot, but I also don't think Europe needs to, because they're on a different development trajectory than sort of the emerging part of the world, the global south that it's often referred to. So that was question 2. What was question 1?
Question 1 was about reshoring versus comparative advantage.
Reshoring, yeah. I think what we've discovered, starting with COVID and going through these really kind of these 3 supply disruptions, the COVID supply disruption of the disruption to supply chains with COVID, with Russia, Ukraine, and now with Iran, is I think we were undervaluing the value of inventories and of and the time value of logistics. So I think we will see reshoring, but I think it's going to be reshoring through the sense of I'm now going to put a higher risk premium on not having sufficient inventories, or it takes a long time for the goods to reach me, that logistics time lag between producing the good and delivering the good to the end user. So I think when you rebase those risks, or when you revalue those risks, all of a sudden some onshore reshoring opportunities become economic. Not all of them. Not all reshoring economics are going to work, but some of them will, because when you rebase the cost structure, all of a sudden the comparative, to your point when you said in your question, the comparative advantage isn't as large as we thought it was now that we're incorporating things like logistics and inventory costs. And in some of those cases, the comparative economics are going to flip, and that's going to be your reshoring case.
Oh, bunch of questions. Chuck.
I'm the last person to put my hand up. You really should.
Okay, over here.
Sure. Well,
But you can
Hi,
call me.
Thank you so much. Really fascinating discussion. So you referenced the shale revolution, and in particular how it enabled the United States to move into being a net exporter of natural gas, which enabled Europe to have an alternative resource base when everything happened with Ukraine and Russia. But if I'm sitting in Europe or Asia right now, I suspect that I'm not looking at the U.S. as favorable of a trade partner. So I'm wondering if you can comment on your thoughts related to transition, related to the concept of risk, sort of post this conflict geopolitically. What does the energy system look like, in particular with the U.S.'s role in that global energy system given?
Okay, my 20-second
Second
paraphrasing.
paraphrase.
No, you're good. So my 20-second paraphrase. There's been talk in the context of, the United States' role in this conflict in Venezuela, in the context of tariffs, of other countries, other regions of the world, seeing us in a different way in terms of reliability as a trade partner. How does that play into this discussion? Is that okay? Yeah.
Okay. All right. So I'll start with a factoid, and the factoid is the U.S. has signed more long-term LNG contracts with Europe in the last 12 months than in the previous 24 months. So despite all the tariff tensions and stuff, there is still the reality of, not that tariffs come and go, but we've got a lot of contemporary friction, but we also have this fundamental need over the next 20 years. And so like the fundamental needs are winning over the tension. Now, the counterfactual of that would we have signed even more long-term contracts with Europe had we not had the tariff tension? And I don't know, but my intuition would be yes. So I think it is having an impact on the rate at which deals are done, but I think the deals that need to get done are still going to get done. And when I think about Asia, I sort of think, I was actually really kind of amazed with all the tariff and trade tensions we've had with Asia for the last 12 months. The fact that we were able to increase crude oil exports to Asia by 1 million barrels a day in a 4-week period kind of tells you that, necessity is the mother of invention. Is that you kind of do what you have to do. Now, the thing about crude oil is that crude oil doesn't trade on 20-year contracts. So the real question is going to be, when the situation in Iran resolves, what happens to that 1 million barrels a day? Does it just vaporize? Because those contracts are probably, I'm going to guess they're signing probably 3- and 6-month contracts, because that's kind of the average contract tenor for oil contracts. Will they renew them? Or will they go back to the Middle East, or will they? And the reality is, they're probably going to do something in between. So I would expect that 1 million barrels a day to decline when the contract resolves, but I don't think it declines by 1 million barrels a day because it goes back to that supply diversity. So the other thing I'll say about Asia is having lived there for 3 years, is there is a narrative out there that China has this infinitely deep ability to influence countries in Asia. And I think the only country in the world that actually believes that is China. Or I should say the only country in Asia that believes that is China. There are long-standing issues culturally and sort of geopolitically, armies and that kind of stuff, that there are long-standing issues between China and countries in Asia. And so I think this notion that that Asian countries are going to be persuaded, now that, for example, this morning China announced that they're going to allow petroleum product exports to friendly countries. I think China thinks they're going to buy influence with those barrels, and I think what they're going to end up doing is they're going to end up selling barrels and not buying any influence, because I think there's going to be this, yeah, okay, I'll take your jet fuel today, but don't think that that's going to entitle you to telling me how to vote on the next UN resolution. So I think that goes back to the diversification. And I think one of the things that needs to be kept in mind, which is really not directly answering your question, but the previous question, is diversification often comes at a cost. So you have to be willing to say, I'm willing to pay more to have a more diverse and more secure supply chain than the cheapest available supply chain. And I think that's going to be something that not just Asia, but I think Asia and Europe is going to keep in mind. I mean, I think Europe, that's the critical mistake that Europe made in Russia-Ukraine, is there was a lot of warnings from the US through 3 administrations: do not make yourself overly dependent on Russian natural gas. And constantly got the talk to the hand, right? It's cheaper, and we don't have an alternative source because they didn't have the LNG facility in place. What Russia-Ukraine did, unfortunately for Russia, is it built in supply diversification, because an LNG regasification terminal in Europe could take LNG from the US, Australia, Qatar, Nigeria. It can take LNG from anywhere on the planet. But a pipeline from Russia can only deliver molecules from Russia. And that's probably that's going to be the big cost that Russia is going to play over the long term with Russia-Ukraine, is that they let they kind of open, not Pandora's box, but they let the tiger out of the cage, and they're not going to be able to get the tiger back into the cage and say, shut down those regas terminals and just come back to this Russian pipeline that's solely sourced. And I triple promise that I won't ever do this to you again. I don't think that's ever gonna float with the Europeans. And I think something similar will happen in Asia. It'll be different because there isn't that pipeline connectivity. But I think we're going to see something similar to that in terms of diversification in Asia.
We're out of time. Thank you all very much for your great questions. Skip, thank you for taking the time to come here, share your insights with us. Please give Dr. York a round of applause. If you want to listen to this and other episodes of Grounded Not Divided, you can find it at the Guided Civic Revival Substack or on Apple Podcasts or Spotify or wherever you get your podcasts. And we'll see you next time. Thank you.
Right.